Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us at the MarketSite studio, we have Chris Bell, Managing Director, National Head of Sales at Horizon Kinetics, to discuss the benefits of an ETF versus a mutual fund. Chris, it's great to have you with us. Welcome to Trade Talks.
Thank you very much.
You got it. And before we get into the benefits, why convert a mutual fund to an ETF?
So it's the evolution of the brokerage industry. Back in 1940, when you had the Investment Company Act, it was a regulation for mutual funds. And so mutual funds from 1940 until, most recently during all these conversions, that was the product that advisors wanted, and that was the product that individuals wanted. However, today, because of taxation, because of fees, because of a number of other reasons, you're in an environment where people want faster trading, they want instantaneous intraday trading of mutual funds, ETFs, and they want the ability to have it all at a cheaper fee.
Right.
And so it's really the evolution of the industry.
Right. And my question then is, the benefits of an ETF versus a mutual fund are certainly what you had mentioned before.
Fees.
Right.
And you're able, as each transaction happens, you're able to allocate the tax gains and more easily. So you don't have these large tax loss carryforwards or these large embedded gains in mutual funds, like you do in mutual funds.
Yeah, I would imagine the thematic nature of ETFs too is certainly attractive for investors.
It is, and so as a firm, we manage $8 billion, and this fund is a very small fund. It's $20 million, but so we have a lot of different strategies. But today, I think people, if you do have something thematic, then they want it in the ETF wrapper. And
this fund is 23 years old. How has the industry evolved since then?
So I will tell you that 23 years ago, Paul Abel, my friend and portfolio manager, would have told you that it was 1/3 large cap pharma, 1/3 profitable biotech, and 1/3 in what we called publicly traded venture capital, companies that should never have gone public, but because the markets were going so crazy in the late 90s, they were able to go public, had a lot of cash, so they could take care of a cash burn during a period of time. Today, it's really just biopharma. Like, the two have merged. So, one of the things that I will tell you is that strategy really worked. So over the last 23 years, we've outperformed the Standard & Poor's 500 by over 200 basis points, or 2 full percentage points per year. And we've done it with 2/3 of the volatility. And if you're an advisor out there, you know what Sharpe ratio is. The S&P 500 Sharpe ratio during that whole period was 0.34. Ours was 0.43. So, and that includes fees.
Right.
So we've been able to lower the fee now, make it more tax efficient, and you've got the same manager that's been around for 23 years.
What technology excites you most?
Oh gosh. I think AI is going to be really, really important in that field. And just some news the other day about the potential for an mRNA vaccine for prostate cancer. That's going to happen so much over the next 20 years. It's just going to be we're going to live in an amazing time.
Yeah.
So it's very exciting.
It certainly is. All right, we appreciate the insight. Chris, thanks for joining us.
Thank you so much for your time. I appreciate it.
Thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.